Please welcome the panel on Global Debt Levels, Opportunity to Innovate, moderated by Director of the Geo-Economics Initiative at the Milken Institute, Matthew Aleshire.
Turning that off. Can you hear me okay? Mic's live? Perfect. Okay. Well, thank you for joining us today for this important conversation on global debt levels and opportunities to innovate in that space. I wanted to start off here by just sort of giving a lay of the land in terms of the scale and scope of the current debt challenges. And, right now, global debt levels are near an all-time high. I think the IMF late last year estimated that public debt levels are at or in the process of surpassing $100 trillion. That level is likely to rise over the medium term. High levels of public debt in many countries with advanced economies threatens to crowd out potentially more productive investments in the decades to come, while developing countries, lower middle income countries now face challenges due to higher borrowing costs. While country-specific conditions create significant variation across geographies, it's been estimated that developing regions borrow at rates that are 2 to 4 times higher than those of the United States. I've seen anywhere as high as 8 to 12 times higher for Germany. And I've seen it estimated, and I think this goes back maybe 2 years at this point, that in 2023, over 50 developing countries spent more than 10% of their revenues on interest payments. So the scale and scope of the existing debt burdens is significant. I think, Mr. State Secretary, I would like to turn to you first. Heiko, you're the State Secretary for Financial Market Policy, European Policy, and International Financial Policy at the Federal Ministry of Finance in Germany. Involved in this conversation, there are significant opportunity costs involved with the rising debt levels around the world. What do you see as the trade-offs involved, both at a macro level and then also for decision makers at a policy-making level?
Well, thanks for having me here. Let me start by saying that we actually do have concerns about global debt levels. That concerns the low-income countries, middle-income countries. It concerns the US and China. We are also concerned about some countries in Europe, and of course in the monetary union that is important. But you will forgive me that after what happened in Germany yesterday, I'll talk for just 90 seconds about what that was, because it was really a historic day in terms of our debt history, because we agreed on a complete makeover of our debt break rules. So this is something that will give us a lot of fiscal space in the coming years. So what we agreed on was to exempt all defense spending which is above 1% of GDP from the debt break rules. We created a new special infrastructure fund of 500 billion euros for the next 10 years. We also will exempt the lender and municipalities from the debt break rule and give them more fiscal space, 0.35% of GDP. So overall, that will create more fiscal space of around about 3 to 3.5 percentage points of GDP. That's actually quite substantial. And this is something that creates a new environment. This, of course, will bring up our debt levels over time. And of course, we have to think about how to spend that money wisely, how to make sure that our growth potential goes up, that we use it in a wise way. It will increase our federal budget from this year to the next by around about 25%. Good news is that Germany still is at just 63% of debt to GDP ratio, which gives us fiscal buffers, very much opposed to other parts of the world. Federal debt to GDP ratio is just 40%. But of course, our debt to GDP ratio will now rise, and there are of course, trade-offs. That's what your question is. So Germany, as an anchor of the Eurozone, will have a new role, I believe, under these new circumstances. This will, of course, have inflationary effects. That seems to be relatively obvious to me. And debt service payments will go up, and this will restrict fiscal space in the future. And this will, of course, and I believe we'll talk about that later, areas like spending for development cooperation, climate financing, and there will be eventually, and now I'm coming back to the fact that we are indeed in monetary union with special challenges. We are even, of course, looking at what it means for financial stability.
No, thank you. That's quite comprehensive and quite timely on the announcement for the debt break. I like to think that it was timed for this platform here today and the opportunity to take advantage of that. Stacy, I wanted to turn to you next. You're founder and CEO of Resilient Earth Capital, but you also spent a very long time in development finance institutions. So you've worn many hats and have varied perspectives that you can bring to this conversation. So at the macroeconomic level, what do you see as some of the challenges right now in terms of the overall debt burden and, again, coming back to that question around trade-offs?
Yeah, so thank you for having me, and it's a pleasure to be here. A couple of other hats that I've worn during my career, I sit on the board of something called the Green Guarantee Company, which is a special entity that was set up specifically to take different types of public climate finance capital, leverage it with private capital, and provide guarantee instruments to credit enhance investments that have, in the global south, that address climate issues, whether it's infrastructure or resilience or both. I also sit on the board of a green bank, which is a specialized financial institution at the hyper local level here in the United States, which essentially drives capital to the infrastructure that's needed for the clean energy transition. I have also worked at the IFC. I was the first head of its blended finance funds. And in the context of some of those other things, I have advised the G20 on sustainable finance. Avi and I are currently on a working group that's looking at debt sustainability levels and climate issues in emerging markets. These are all connected, right? The on-the-ground work, the instruments, the funds that we put together, the financial institutions in the private sector, the development finance architecture, the macroeconomic pictures are all connected in an ecosystem together. And obviously, at a very basic level, debt sustainability is a problem. It's a problem for emerging markets. It's a problem for a company that's over-levered, right? If you are paying more to pay your debt service every month than you are bringing in, or you don't have enough to do more than pay your debt service, you are not going to be a growing company, let alone a growing economy, right? So we have these, kind of almost like motherhood and apple pie concepts that apply at the country level, at the sovereign level, and all the way through the economy into kind of small businesses. And then we have an ecosystem of actors that are there to both help catalyze positive economic growth and development, but also mind the system, throw up red flags or kind of red lights or yellow lights if we're finding ourselves on a path to kind of unstable kind of debt issues. And then we have to deal with that, right? At a company level, I mean, because you asked about kind of trade-offs, you asked about, in our prep call, you asked a little bit about kind of what you're seeing, what I'm seeing kind of at a macro level in terms of where this goes. We also, debt is a contract between a borrower and a lender. It depends on a certain type of counterparty credibility. People buy sovereign debt. People, need to count on those sovereigns or those companies to repay their debt. That credibility issue is the basis of how we price and how we size debt, how we interact in the kind of economies together, all the way from the macro level, all the way down to the ground. And this is a very, very big problem. The panel at lunch touched on this in some really interesting ways, and touched on it as it relates to potential things to watch about our own debt ceiling issue in the United States that's going to come up in a couple of months. And really, it's going to require not just fixing the amount of debt one can take, that's one thing, but the hard questions, trade-offs, strategies about fixing structural problems that need to be addressed for long-term sustainability. My career has been spent working at the nexus of climate and investment. Climate is a huge headwind. Debt sustainability issues are a drag on the economy, but climate's also a headwind. You put those two things together and we're in a really interesting, difficult pickle. And of all of the things that we're dealing with in the world today, climate is probably the most certain. We have a world at this point in March of 2025 where uncertainty is really high, investor sentiment is really low because of that. Climate change doesn't care who you voted for or what happens politically, but boy, it's kind of certain. We know that the effects from a warming planet are going to have damages, have losses, affect insurance markets, affect profitability, affect bankability, affect cost of capital. We know these things to be true.
Thank you. I want to come back to the point around uncertainty, but Avinash, picking up on the point that Stacy mentioned around dealing with the sustainability, or in many cases, the lack thereof, of the debt burden. You're currently at the Inter-American Development Bank as Special Advisor on Climate Change to the President. You have a long, illustrious career in the private sector at financial institutions, but you also served as the Special Envoy on Financial Services, and let me make sure, and investment for Prime Minister Mia Mottley of Barbados. You were there during a time frame where Barbados restructured its debt burden, shall we say, its sovereign debt. Are there, when we're talking about some of the macro challenges here, are there lessons to be learned from that restructuring process that you went through that maybe highlight some of the tensions that exist within the existing frameworks for dealing with the debt burdens of developing countries?
I learned a lot from that process. I used to be a writer and a thinker about these issues from London, and actually being on the ground and dealing with an actual restructuring taught me a lot of lessons. And I think it links quite nicely with some of the things we've heard from Heiko and Stacy, because it's made us think a little bit about debt in a deeper way than just the total level. So one of the things that Heiko talked about at the beginning is that we, as economists, have this prevailing idea that we need fiscal stability, macroeconomic stability, that will allow growth to happen, allow interest rates to be low. But we seem to be stuck. We seem to be stuck in a bad balance where this focus on these debt ceiling levels is making us end up not investing, which is ending up with low growth. And we've learned that one of the best ways of dealing with debt is to grow. So you're going to have a debt problem if you're not growing. And in the past, we've kind of thought of debt sustainability as kind of totting up the amount of debt. It can't be more than X percent, 82%, 60%, whatever the number is, right? But what we learned, and I learned that in looking at the debt sustainability analysis in our debt restructuring, that it does also matter what you're spending the debt on. Right. I mean, rather it didn't, because it would be so much simpler, right? We just can just add up the debt. But what's happening now with some of these rules, and in the same way emerging markets are facing this rule on debt sustainability, Germany is facing a rule on the fiscal break, the US is facing a rule on the debt ceiling, when there is investments, for example, in climate resilience, where the studies by the Inter-American Development Bank and the World Bank show that the savings, the fiscal savings, are 10 to 15 times more than the investment. So it's the fiscally prudent thing to do is to make that investment, right? And yet the debt sustainability analysis tells us we can't. We've got no room for it. So in fact, some of these ceilings and breaks are leading us to make fiscally imprudent decisions that are not only bad for the fiscal system, but they're bad for growth And that's going to lead us into problems. Now, I don't believe that there are easy answers to this, because every government believes that everything it's doing will lead to fiscal savings in the future. So it's how you define fiscal savings. How do you really, you need an independent person to say, yes, there will be fiscal savings there. And so maybe that debt counts differently than debt that doesn't lead to fiscal savings. But we need to think differently than just adding up debt.
You mentioned the DSAs, or the debt sustainability assessments at the IMF, the debt sustainability framework that they have there. Heiko, I wanted to come back to you to really ask, there are a number of forums, mechanisms that are in place currently to work through debt challenges, through the G20, the G7, the Paris Club, DSSI. There's a long list of them. You're, through your current portfolio, involved in most, if not all, of those. What do you see is working, and where maybe is there room for improvement?
Yeah, well, let me start by saying that we believe that there really is no systemic debt crisis at this point in time, but there are countries, especially low-income countries, middle-income countries, which are facing big challenges. And there are clearly countries in debt distress and countries which are struggling. So we need to address those issues. And what we have worked on in recent years was, of course, the G20 common framework, which I believe is important, which has made good progress. We have made good progress in Zambia, in Ghana. There is progress on the way in Ethiopia as well. So this is good, but this is not good enough. There are positive developments, but we have to work on that framework, that the countries are still not quite sure what it actually entails for them. The timelines are not clear. The processes are not really clear. So this needs to be improved. But then again, there is, and I just come back from the G20 in South Africa, where we only touched upon this, but there is no consensus within the G20 on really how to move forward. So this is a good instrument, I believe, but it can get better. But let me, when I talk about not having consensus on this, maybe mention briefly the big elephant in the room. Of course, we still don't know what the new US administration actually has in stock for those formats, or what the position on the G20, even on the G7, but clearly on the IMF, on the World Bank, will be, and this will be, of course, of the essence in the end. If we want to make progress on something like a common framework, we need everybody in.
Yeah. And I think that it's an interesting point, too, when you talk about sort of the various voices, creditors, so to speak, stakeholders that are in the room for those conversations, because we've seen an evolution over time of in the creditor composition, from bilateral lenders, countries making loans historically, financial institutions, and now the creditor side of the equation is much more diverse than it used to be. This is an open question to the group here. Maybe Avinash, will start with you, and then to you, Stacy. In terms of that creditor composition changing over time, how, to what extent do you think that has complicated attempts to resolve challenges?
Complicated, or certainly changed it. I think in a way, in many issues, international finance, we're kind of stuck debating the old debates when the world has changed. So the vast majority of debt for developing countries is private creditor debt. It's held by private creditors. So it's not a Paris Club debt. Now, and Paris Club debt is official debt, official sector debt. Germany, Britain, France, they're not banks. So when they lent in the first place, it was a political decision. So restructuring is going to be a political decision. And so there's lots of politics involved in that mechanism. And that's very different than dealing with private creditor debt. Now, with the private creditors, what we look around at developing countries, one of the things that I observe myself in going through our restructuring is the huge opprobrium for a debtor to restructure. Countries don't restructure enough. there are very few restructurings. And if you take out the odd serial defaulter, very, very few restructurings. And why? Because very few governments get re-elected after they've restructured their debt. When you restructure your debt, if you need to continue borrowing money, you need an IMF program that gives reassurance to the creditors that you won't keep on restructuring your debt. IMF programs are tough to win re-elections from. And so I think we need to have a system. The system is biased against restructuring, partly because of the shame of it and the worry of it. I spent 2 years advising my old university friend who became prime minister, trying to develop all kinds of acrobatics to avoid a default, until I bumped into the governor of the Central Bank of Jamaica, who I said, so what advice can you give me? They'd gone through a few restructurings, and he said, when you're restructuring, you need to go big. He said, trying to do delicate little acrobatic reprofilings only mean you go back and do it again and again and again, and that's the worst thing for your credibility. A restructure, have a sustainable level of debt, and hope you never need to do it again. And so that is the way, that is the different world in which we're dealing with. The Paris Club is important. The G20 common framework, it's important, but it's actually not the biggest problem we face, which is how do we deal with excessive levels of private creditor debt, where it is excessive, and how do we do, we don't want countries to be restructuring all the time. Why would a private creditor lend? But we need to make sure that they aren't clinging on by their fingertips when they should be restructuring.
It reminds me of, I think it's the old Eisenhower line, how do you solve for an intractable problem? Make it larger. And this is sort of a spin on that, right? Stacy, when we're talking about the creditors and investors here, coming back to that question around uncertainty, right? Not only does that impact the restructuring process, but then it has real-world implications in terms of actually trying to make investments in projects or apply any of the funds that would be that would come out of or be freed up in a restructuring process, right? From your sort of investment lens, how does that compute for you?
So maybe I'll pick up from something that Avi said, a handful of minutes ago, where he said it matters what you spend the money on, right? So you have the debt restructuring, you have the debt sustainability issue, you have the debt restructuring. Maybe we get rid of the shame part of that so that we can have a real conversation about how to kind of restructure debt in order to kind of catalyze growth. Here I'm talking kind of generally if you're in an emerging market circumstance, but the same idea applies if you're talking about a company that is also kind of in a similar position, or a sub-sovereign like a municipality, right? But then there's the day after, and the plan matters, and the plan matters a whole lot today in the context, and I'm going to kind of talk about climate change because that's what I do, but whether you talk about the weather, whether you talk about extreme heat, whether you talk about water stress, whether you talk about ag productivity in a country that has 50 or 80% of its GDP caught up in the ag sector, or, however you're going to think about what you do next, how you spend the money, how you plan matters, right? And thinking about this strategically in the context of the public balance sheet is not infinite, right? You don't want to put yourself back in a situation where you find yourself 5 or 10 years after restructuring back in the same debt sustainability question. You should be thinking about how to allocate your scarce, precious public balance sheet resources to the highest and best value, while at the same time catalyzing private investment, growing your private sector, and growing your economy. Doing that through the lens of sustainability, in my mind, includes addressing climate-related financial risks to the economy. But we talk a lot about risk, and the debt sustainability question feels like a downer in some ways. But I will tell you, it's the biggest investment opportunity on the horizon today, full stop, right? We can invest in the clean energy transition, in making things resilient. It can create jobs, it can create economic activity, it can crowd in private capital. It's all there, and we have the toolkit among the public public entities, the development finance institutions, if you're talking emerging markets, but also the public balance sheet for domestic lending that can help. One other thing I will say, if you're investing in resilience, it does come back. It's starting to show up in things like sub-sovereign credit ratings. So S&P has rated muni bonds here in the United States for some cities in Florida that have a resilience plan, and they've rated them better because they believe in the plan of the municipality on resilience, they believe in the governance of the entity, and it's the thing that's going to be most sustainable from a fiscal and financial perspective. So this is not just a do-good thing, this is actually kind of a real financial opportunity, upside, efficient way of using your public balance sheet, et cetera.
I want to pick up on that thread around the toolkit and the mechanisms that we have. I know we've mentioned climate resilient debt clauses or state contingent debt instruments. There's a number of very specific, I would call them market-oriented mechanisms that can help over time to ameliorate some of the worst of the debt burden or the challenges that can arise within a restructuring. I draw back on the enhanced collective action clauses and the lessons learned there over 15 years of slowly implementing them. Heiko, in terms of the toolkit, and I know we're running short on time here, so I want to give everyone an opportunity, starting with you, to maybe look at the toolkit and the landscape before us and identify sort of where there is cause for optimism. It's easy to get cynical a little bit about the challenges, but as you said, there is not a systemic issue at present. So again, what gives you optimism in this sense?
Well, that's a hard question these days, but let me just answer in a more general way. Coming back to the one point I really want to make here, but you asked about the creditor landscape these days earlier. I looked into the Plaza Accord in 1985 recently, when a 3.5% deficit of the US was considered to be a huge problem. And when we addressed this, but there were two creditors, basically two creditors of the US. It was Japan and Germany. Yeah, this has changed, obviously. This situation becomes more global. Same is true for other countries which are in debt. That the creditor landscape is different, so it has changed. That means that we cannot solve debt issues, debt sustainability issues with just a few countries on the table, which makes the common framework so important, which makes it important to bring in others. And I want to specifically mention China here, because they are today the biggest creditor of low-income countries and middle-income countries. They have engaged, but I think we would like to see more. But this, of course, takes an effort by all of us. We can only do that if really everyone who is a member of the G20 takes this responsibility seriously. And I believe there's still room for optimism, because this forum is still there. It still can be used. It still can be made fruitful. And this is what we are working for, at least.
Thank you. Stacy, back to you in terms of a point of something that keeps you optimistic about the discussion here.
Well, there's some really, really smart and incredible people who are working on this, and that gives me some hope. I think, we need to be in a situation where we're playing as much offense as we are playing defense on some of these things. And whether you're talking about the fiscal kind of issues that we have to deal with, and something Maya McGinnis said on the lunch panel, just kind of struck home, which is that this is very, very, very hard work. It is not for headlines, and it's not for clickbait. It is really hard work, and having people who are rolling up their sleeves trying to think about the best outcome in a difficult situation is, and a politicized situation in many ways, right? Is not easy, and the fact that there are so many really good people working on this gives me some hope. I also think investors, notwithstanding some of the ebbs and flows of ESG backlash and even in emerging markets. I think investors have started to wake up to, at least from a sustainability and climate perspective, to the financial implications. And to the extent that that's true, I hope there's more walk in the system versus talk.
Perfect. Avinash,
We're gonna-
word to you.
We're going to have more debt. Climate resilience is expensive. Development is expensive. We need the debt to be more affordable. We need it to be longer term to capture the savings of investing in resilience. And we need it to be more shock absorbing. So these climate resilient debt clauses are really important. MDBs, let me end with that, need to be probably 2 or 3 times bigger, because they're the ones who can borrow at AAA rated levels, AAA rated levels, and then on-lend that to countries that have a CCC credit rating or a BB or a B minus. That's the way in which we get private capital mobilization to get cheap funding to developing countries.
Wonderful. With that, I think we're going to have to wrap up the panel. So I wanted to thank each of you for participating, and stay tuned for the next session.